So now next, let me get into margin, leverage, and spread. Much simplified because, I had to give you the technical definition in here. But margin refers to the collateral or security deposit required by the broker to open and maintain a trading position, meaning the money in your account. How much money do you have in your trading account, in your brokerage account? It is essential to manage your margin effectively, keeping a sufficient balance in your account to cover potential losses and avoid margin calls, which is the forced liquidation of your positions. What may happen at that point is your broker, first, you're going to exceed a certain margin percentage, which will force your broker to activate that margin call, which is an attempt to save your account from being blown. But unfortunately, by the time the margin call happens, and this goes for everywhere, every broker, it don't matter. Across the board, regulated, unregulated, it doesn't matter. The moment a margin call happens, it's too late for you. Your account is gone. You might even owe the broker money afterwards. So it is essential to keep your risk in check and avoid that margin call. Next is leverage. Leverage is a borrowing facility provided by the broker that enables traders to control larger positions in the Forex markets with a smaller amount of capital. Buying power. That's what leverage is. Buying power. Regulated brokers, since they care about you and want you to succeed, and they are what we call A-booked, so they trade and manage everybody with their own capital. They have more than enough to pay you out, do whatever, right? So because they want you to have longevity in these markets, they're going to give you a smaller amount of leverage, as opposed to unregulated brokers, which we call B-booked, B as in ball, where most of them make profits off of your losses. So this is why they give you an increased leverage, so you can blow your account quicker, because you're a newbie that's still greedy, you still got the greed in you. They give you vows to flip $10 into 20,000 with one trade. That's what they want you to do. Spread is the difference between the buying and selling prices of a currency pair quoted by the broker. Tighter spreads are generally better, but it's important to choose a reliable broker that offers fair and transparent pricing. It is also essential to understand that spreads can widen during news releases or volatile market conditions, which can increase trading costs. So if you try to trade news events, spread will increase. So even though my positions were well far away from going in the red, those spreads made it seem like it wasn't such. So it's crucial to pay attention to that spread, as well as these other two up here.